Welcome to Main Street, your go-to place for understanding the stock market and the economy in a way that makes sense. We're here to break down the latest news and trends so you can stay informed without feeling overwhelmed. So grab your coffee and let's dive into what's been happening lately. As of Friday, June 13th, the stock markets took a bit of a dive. Dow Jones Industrial Average dropped about 770 points, or about 1.8%. S&P down 1.13%. The NASDAQ Composite lost 1.3%, causing it to settle about 19,406. What caused all of this? Well, Israel launched airstrikes against Iran, which not only heightened geopolitical tensions, but also pushed energy prices higher. When there's uncertainty like this, investors often react by selling off stocks, leading to a market decline. In addition to geopolitical tensions, we also saw some important economic indicators last week. First, the latest job growth figures came in, showing that while hiring is slowing, the unemployment rate remains low at about 4.2%. This indicates that people are still holding on to their jobs, which is a good sign for consumer confidence. Second, inflation data was released, both consumer price index and producer price index surprising to the downside, showing that inflation is more contained than previously thought. This is a positive development, and it helps ease some concerns about rising costs. Looking ahead, we got a few key things to watch. First off, the situation with the tariffs and trade negotiations, especially with China, continue to be a big topic. While we've seen some frameworks being established, there's still a lot of uncertainty, and that could affect the prices in the economy. Another key element to keep an eye on is a potential U.S. tax bill. There's a lot of discussion about how it might play out in the Senate, especially with the July 4th deadline approaching. We're going to keep an eye on that. While some proposals could provide a slight boost to the economy, like extending certain tax cuts, the overall impact might not be as transformative as some would hope. It's really about how these changes could influence corporate spending and consumer confidence moving forward. If businesses feel more secure, we could see an uptick in investments and job growth, which could be a positive sign. Now, many experts predict that the Federal Reserve might cut interest rates 1 or 2 times in 2025. This could be their way of supporting the economy if things start to slow down. But honestly, it wouldn't shock me if we don't see any cuts this year at all. It's all about how the economy responds to these tensions and trade dynamics. So what does all this mean for you and your investments? Well, I think it's important to stay calm and not panic during these dips. The economy is still fundamentally strong, which means there are a lot of opportunities out there. Here's a tip. Think about dollar cost averaging. This is where you invest a fixed amount of money at regular intervals, regardless of the stock price. This strategy helps you try to avoid timing the market, which can lead to better long-term results. As we navigate this uncertain landscape, I predict that the market will be range-bound for a bit. What that means is that we might see the market moving up and down within a certain range instead of making huge leaps in either direction. Many investors are eager to buy during pullbacks, especially after a strong rebound like we saw after a previous dip right after Liberation Day, after the April 1st decline. However, they're also cautious about buying things at the highs. In this environment, it's essential to keep a balanced portfolio. Investing in a mix of sectors like financials and healthcare can help cushion against volatility. Remember, while there's potential for good opportunities, we don't want to chase every uptick without considering the risks. In short, stay informed and balanced. And remember, even in times of uncertainty, there are always opportunities. This is your place to come for breaking down the news in a way you can digest and understand. If you have any additional questions or need resources, feel free to reach out to the Economic Hotline at 917-809-4231. We can provide valuable information to support you navigate these economic conditions. Thanks for tuning in. See you next time on Main Street. Be the change.